Hello, folks. Alan here. I'm just in the stages of getting the show live on. This is the pre-production part of the show. I'm just in the process of getting everything live on various websites, and I've got the first part done. I'm just now making sure that this is all live on my website. So just give me a second here. We're almost ready to roll. Just a couple more seconds here, folks, and I'll be live on the website. My guest, Eric Coffin, is already ready to roll, so we're in good shape here. I'm just gonna, I gotta update my website now, and we are live and ready to roll on the website, I believe, once it updates. Lots of fun and games here, folks. Okay, so we are live on the website, live on YouTube. We're ready to roll. Thank you very much for joining us. I'm Alan Barry Laboucan. I'm the founder of the Alan Barry Report and the host of the show. Today we have one of my favorite guests, Eric Coffin of the Hard Rock Advisory. Eric has been around the business for a long time. His brother and him started the Hard Rock Advisories. Have done a great job picking stocks over the years. You've seen him at mining conferences. You've seen him on television. Eric, thanks for joining us today.
Always happy to be here, Alan.
Excellent, excellent. So we before we get started, Eric, you know the routine. I'm going to get started with my website sponsorship messages. So first of all, one of my sponsors is Premier Gold Mines. PG is their symbol. They trade on the Toronto Stock Exchange. They have an enviable portfolio of projects from exploration through to production with partners like Centerra, Goldcorp, Barrick. And recently they had news out about their Hosaga project in Red Lake, Ontario. Check out their website at premiergoldmines.com to do your homework. Another sponsor I have is Wolfden Resources. WLF is their symbol on the Venture Exchange. Wolfden has an exceptional new discovery of high-grade nickel, copper, and cobalt near Snow Lake, Manitoba, only about 10 miles from Snow Lake, Manitoba, which is a major hub of base metal production in Manitoba. So they're well situated, getting good drill results. WolfdenResources.com is their symbol. That's WolfdenResources.com to do your homework. Another sponsor is Sirius Resources. Sirius Resources symbol is SOI. They trade on the Venture Exchange as well. They're a gold-focused company that's drilling the high-grade gold project at Chichu project in Quebec. It's located next door to Goldcorp's Eleanor Gold Mine, and they're about to start drilling again. They recently had some drill results out, which gives us a better picture of all the results that are in from previous drilling. And then they've done that on top of the geological map, so you can start to get an idea of how much they really have there to go as far as work. They're early stages, lots of work to go. Sirius is SIRIOS.com/en./ to do your homework. And the final company is West Red Lake Gold Mines. They trade on the Canadian Securities Exchange with the symbol RLG. They're a gold-focused company as well. They have a project in Red Lake, Ontario with Goldcorp as their participating sponsor. 60% is owned by West Red Lake Gold Mines, and they are now drilling their exciting hinge zone target in Red Lake that I'm very excited about. WestRedLakeGold.com is their website, and I encourage you to do your homework on all of these companies. They have a very attractive group of projects, and I invite you to check them out. Eric, you got any comments on any of my sponsors?
Yeah, I mean, I actually need to update RLG myself, because I realized as you were talking that I hadn't done it. Now that they are in so I assume that the bit's not getting stuck or anything. And I like the target, same as you. It's a high grade sort of shot in the dark, but I like the fact that it doesn't actually have many holes in it, which isn't something you can say for many things in Red Lake, because a lot of those properties have been drilled like they're Swiss cheese. But I like the idea of a new open target. I mean, they've got a 1 million ounce resource to underpin the value, so I think that one's a good shot. I kind of liked what I saw from Sirius too. I mean, given how long it took to get those drill results out, I have to say my expectations weren't high. Maybe I've just been doing this too long and I'm cynical, but whenever it takes that long to get drill results, I assume the worst. But, in fact, they did, it looks like they did manage to actually connect the dots. They've got yet another interpretation that seems to make more sense. I mean, a series of northeast trending structures, and they've got several intercepts in most of them now. And I think that's what we all kind of suspected. And certainly what Dominic suspected was that having assumed that the trend was northwesterly for the first 2 or 3 years of drilling, it turns out the high grade trend's probably northeasterly. And I'm fine. Obviously, if you're dealing with 1 or 2 meter wide zones, you got to put a lot of holes in them to build up tonnage. But if those grades are for real, that works for me. And I found the fact they got some intercepts in what he calls the sort of the far northwest zone outside of the tonalite. I thought that was kind of interesting. I know there's no outcrop up there, so that was completely shot in the dark, drilling a soil geochem anomaly. So there's no pretense from them. They know what's going on. But I think it's interesting that they've got a couple of completely new areas to test on top of these northeast trending structures that appear to be starting to hang together finally.
Yeah,
it's lots of budget, so they'll just drill and drill and drill, I assume.
Yeah, I don't think they're going to have too much problem on the budget end of things. And as you were talking there, Eric, I pulled up their website, and I have the screen share going right now with the news release that includes the images that they put together for the recent drill results. And it really shows a good package of excitement here. You mentioned the Northeast, and I'm right now circling the limited amount of drilling that's been done up in that Northeast. And when I talked to, in the past, when I talked to Dominique about these results, he had mentioned that they were, I asked if they would have chose to turn the drill rig the other way maybe, and he said, yeah, we're now getting a better handle on the geology and the metasediments, the tonalite, the contact of the two. I'm pretty encouraged that they've hit holes out in the metasediments as well as in the tonalites. They got a lot more gold than I was expecting in that latest batch of results, Eric.
Yeah, no, same for me. I mean, I know it did take. I know a lot of the holdup was simply logistics. When they were out in May doing the Metal Investors Forum, Dominic told me that they literally just the day before shipped the last core, which surprised me a bit. But I know it was a bit of a job to get the core from the property out to Chicoutimi, where they were actually doing the cutting and the logging. But let's be honest. Whenever you wait 3 months for drill results, you kind of expect the worst. So
yeah, exactly.
I was honestly pleasantly surprised to see how many high grade hits as they got.
So was I. I mean, it looks like there's gold all over the place there, Eric. And now they just have to try to focus in, and they're learning more each time they get out there. And now, I think they'll they'll learn a lot more as they do some more drilling, and I'm quite excited about it.
Yeah, no, I think it's one of several companies that's going to be providing a little bit of interest and excitement this summer. I mean, it's quite gratifying to see that if you look at the venture exchange as a whole, the exploration companies, if you will, have raised more money up to now this year than they raised all year last year. So there's a bunch of guys that are ready to rock and roll again and get out in the field and get things done.
Perfect. Well, Eric, I got you here. Thanks a lot for your input on the sponsors, Eric. But let's get on with why I got you here. The reason that I wanted to talk to you again, Eric, is last week we had the Fed doing their thing or not doing their thing. And that had a lot of consternation in the market. And now this week, we've got the Brits voting whether they'll stay in the economic European Union or not. So, you've always been one that helps us sort of walk our way from what's happening on Wall Street to Howe Street. So I thought it was a perfect time to get you in here, considering we just had the Fed meeting and we're about to face this British vote. So what do you want to start with, Eric?
Well, I mean, in the Fed meeting, I don't think anybody, by the time the Fed meeting rolled around, I don't think anybody was expecting them to pull the trigger and raise rates up.
Now, that was something that changed quite quickly, Eric, I think, because prior to the, there was a big report out that, scared everybody. And I think then the consensus became that they're not going to raise. But I think there was a fair amount prior to that report that there was concern they would raise in June.
Well, most of the FOMC members who regularly give speeches, they were running around in mid-late May. Essentially, they were all running around telling people, June's a live meeting. Odds are pretty good that we're going to raise rates in June, and if we don't do it in June, we're going to do it July for sure. And I don't think there's no mystery that the Fed would really like to have some more ammo for when things turn down, because they know they've painted themselves into a corner. But the thing I found odd about it was a real head scratcher for me right up until the meeting. And I wish I could give you a quick and easy place to find this chart. I mean, I can send it to you, but I can't think of a place where you can grab it and throw it up on a screen share.
Well, if you can send it to me, I can screen share it right away, Eric.
I don't know if I can do that at the same time.
Oh, okay. But no worries.
I don't think I've got a copy of it by itself, but there's a chart. I'll send it to you later, and it's basically it's the employment indicator index that is put together by the Fed. This is the part that I find bizarre. It's an amalgamation of about 19 different employment index indicators, and they build one big index out of it. Now, I mean, obviously, the FOMC,
do they call that the labor market conditions index?
That'd be it. Yeah.
Okay, I'm looking around for it, Eric. Keep going.
Yeah, if you take a look at that, and keep in mind that this index is constructed by the Fed, so presumably all of the FOMC members have seen it since it's their index. If you look at that index, not to put too fine a point on it, it looks like crap. It's been coming off for months now. There was a bit of a blip early in the year, but aside from that blip, it's basically been falling since November, and it's been falling pretty hard too. And that's an index I check occasionally, and having checked that a couple times in the past month, I was quite befuddled by the fact that all these FOMC members are running around talking about the strengthening job market, because the truth of the matter is it's going the other way. And I can only assume that this is the Fed trying to talk up the market. It's not some kind of conspiracy. It's the Fed being honestly quite concerned about the fact that where interest rates are now, if the economy turns down, they really don't have any ammunition. They don't have a lot they can do in terms of rate cutting to try to stimulate things.
But in reality, Eric, what did they really do last time? That they needed to do something. They probably overreacted. They probably overpaid for their overreaction. Had they let the banksters sort of let some of them fall by the wayside, they could have came back in and refunded them all at much cheaper prices, and done a lot more to put money in. If they wanted to get the economy going, they should have been putting that money into job creation. It's not like they don't have a lot of infrastructure that they need to rebuild. Rebuild it. You're going to run up. You're going to get to 20 trillion in debt anyways. So, but it's a little late to do that. And I just don't know if the Fed is, if we're in the waning days of the Fed influence. It sure doesn't. Everybody still pays attention to what the Fed doesn't do and talks, but they really can't do anything. And it's becoming more and more obvious, I think, that the Fed is really without bullets. We're on it alone, Eric.
Yeah, no, they're truly painted into a corner. I really don't. That goes for all of the, it goes for all of the central banks, and the general comment I would make about the market and the gold market, since that's what you and I usually talk about, is, and this is with reference to Brexit. I don't know which way the vote's going to go. I'm assuming that they're going to vote to stay. Not because I've got any dog in the fight, or I'm even going to pretend I know the issue intimately, but just normally when it comes to these kind of big votes, if you want to call them that, votes that are sort of life-changing, I guess, usually, historically, most of the time, the undecided voters, when they're actually standing in the voting booth staring at the ballot, they tend to vote with the status quo. That's just how it usually goes.
Yeah.
Based on how close it is, I'm assuming that the Remain side is going to win, probably not by much. It's going to be pretty close. But my underlying comment is, the underlying thesis I've been going with for months now hasn't changed. It's all about negative interest rates. To my mind, that's what's driving the gold market. That's definitely what's driving outside money coming into the gold market. And what happens on Wednesday isn't going to change that. I mean, you've got a bunch of central banks that, in all honesty, I don't know what the end game is. I don't think they know what the end game is. I don't know how they back out of what they've gotten themselves into, quite honestly. I guess they monetize it. I don't see what else they do.
Yeah, that's a tough situation. But, when everybody's sort of in a race to zero on their currency, trying to, bolster their exports and compete, it's not a race you want to win. I was putting up I've got the US dollar chart up now, Eric, and I'm kind of highlighting this area from May onward. I think that the US dollar strength in May was because there was a growing concern that maybe the Brits were going to exit. And it's been my contention that if they were to exit, it would be very bad for the euro and the pound. And I think that the US dollar would rally significantly and put a lot of pressure on gold and other commodities. And so we saw that kind of action all of May. The US dollar had a pretty good rally from around 92 and change all the way up to 96. And since then, in June, it's really been under a lot of pressure. And I think that pressure is the confidence that they're not going to leave the euro. And so that gives me confidence that we're still in really good shape with the US with gold prices.
Yeah, I mean, I think June was also, obviously, it was the May payroll report was a bit of a shocker for people, and the whole idea the Fed was going to raise rates in June sort of vaporized as soon as the payroll report came out. I mean, I would agree with you if Britain voted to leave, I would think it would be hard on the pound and the euro, and I would also expect to see a jump in the dollar. I mean, it's sort of the risk-off asset of choice. Gold is too, so gold's been a bit of a risk-off asset lately. So maybe it won't get hurt as much as we might fear. But I mean, like a $20 or $30 down day for gold, that they wouldn't.
But you know the deal, Eric. We rarely see gold and the U.S. dollar move in lockstep for very long, right? So that's what that's what I'm pretty concerned about with this
Well,
Brexit.
Although, like what I just said, it was. I think it still hold true in terms of the underlying thesis not changing. Like, yeah, maybe gold gets whacked $20 or $30, but I think that would be a short-term move, not a long-term move. It's not something I'd be losing any sleep over. Wouldn't do a bunch of things in my portfolio when you get that day, but oh well.
Maybe find a couple bargains.
I'm not worried about it. I wouldn't be worried about it as a long-term issue, because I don't think that changes the underlying negative interest rate backdrop, which is really what's driving all of this. None of that's going to, if anything, it's more likely. I mean, the ECB in particular, and probably the Bank of England, they'd both be pouring on the liquidity, and I suspect the Fed and definitely the Bank of Japan would be doing the same thing.
Right.
So you get more. You get the printing presses would be working overtime if that vote, if the Leave side wins that referendum. You're gonna see the ECB and probably the Bank of England and probably the other major central banks are going to be all over the market on the buy side trying to prop things up.
Yeah. Yeah, and that gets expensive and gives us more fuel for our gold bull story. Eric, something that we hear a lot about over the years, and we've obviously seen it in the junior market, is weakness in the summertime. I've kind of been in the camp that this summer is different. I know it's always scary when someone says this market is different. But now we've come out of a 4 or 5 year bear market in gold. We've started a much more bullish market in December and into the new year. And since then, gold's doing very well. And I also see some short term weakness in the US dollar that gives me confidence to think that gold will, be trading upwards of 1300 or better. In that kind of a scenario, Eric. Now, this is assuming that the Brits don't exit and that, the trend of the US dollar being under pressure will continue. But I'm seeing lots of signs that that's the way things are going to transpire this summer. How are you feeling about this season of the summer this year, Eric?
Well, I've been saying for 2 or 3 months to my readers, I don't think there's going to be a big pullback this summer. When things dropped when the gold price and the senior producers dropped a few percent in May, and I can't tell you how many guys I talked to at the Metal Investors Forum. Guys you and I both know. I mean, local guys that are plugged into the sector. They were all kind of crowing about the fact that they sold the first week in May. And I was like, you're going to be buying back higher, but
Eric,
power to you.
I can't. I've always been focused on quality. I only cover about 10 companies or so, and they are exceptionally good companies. Selling in May wouldn't have done me any good. They haven't really given back any of their gains. Some are actually higher.
A lot of them are. I mean, if you look at the venture index, and we all know the problems with it, it's a terrible index for a whole bunch of reasons, but it's the one we've got. You look at the venture index, and it's like, what correction? There was no May correction. It went sort of sideways for a couple of weeks and then kept going higher. And to me, the best analogy, and I'm not a technical analysis guy, so I'm a little bit uncomfortable with the whole analogy idea anyway, but the best analogy for me is it's not 2001, 2003, that era. It's basically 2009, where you're coming out of a horrendous pullback. And, in 2009, everybody and their dog was selling in March or April because everybody was worried the major markets were going to fall back. And everybody was buying back higher in July and August.
When gold was one of the first. Gold was one of the first assets. Gold and commodities were the first assets to recover after the 2008 serious correction. And they were buying back in a panic. And that's not something that I'm interested in doing. I try to be a lot more sober about my analysis and get ahead of the curve. And I didn't, and unless I saw fundamental reasons like that, I thought the gold price was going to drop dramatically. I'm not in the habit of selling quality at undervalued prices as far as I'm concerned. I'm not really a trader that way.
Yeah, I mean, this year, there's no such thing as a one-way move. I'm sure there's going to be the odd pullback, but, barring like a crash in New York, and not even a pullback, a crash, I just don't think we're going to have a big pullback this summer. Like, it'll get quieter, the volumes will drop, the usual, everybody's at the cottage sort of thing. But I know lots of people that are waiting for this 20 or 30% correction on the venture, and I just personally don't think it's going to happen.
Yeah, I agree with you. And Eric, another thing is that I have to thank you for, and our audience, and I'm on the same boat. We had the last time we were on, the stocks had moved, the gold stocks, a lot of them had moved quite dramatically, and we talked about the importance of taking some profits. And so I'm always a believer that taking profits is a much better reason than seasonality to try to make your trades. I mean, I had one that Sabina that I was fortunate to after the news they got on their permits, I was fortunate to get in early at about 45 with my coverage and get out around $1.70 when I said it's time to take profits. And part of the reason for that was the conversations that we had and in our last show. So Are you still in that camp, Eric, that, regardless of what you think's happening with gold from here till the end of the year, taking profits isn't a sin?
No, I don't. Yeah, I don't think it is. I mean, to be honest, I've always been. I mean, as a newsletter writer, my trading's a bit constrained anyway, because I don't do stuff before I tell readers to do it. But because of that, and because I've had a very bad habit historically of being the guy that rides his stuff down to the bottom, which I've done more than I care to think about. I resolved sort of to myself that when this bull started, I was gonna remind readers and keep reminding readers to, regardless of what you think, if you got a stock that's up 300 or 400%, take some money off the table. Don't even think about it. Just do it.
Absolutely.
If you don't do it, the day's going to come when you regret not doing it.
Well, and even if you
just from bitter personal experience that you should. And besides which, you got to be realistic. I mean, the stuff that I cover, where the guys that are drilling, Sirius. I mean, Northern Shield will be in a little while. Colorado's already drilling. All these deals. I mean, these are great projects. I really like the projects, the companies, the management. But I mean, drilling is drilling. None of these things hit 100% of the time. That's exploration. I mean, if they knew it was going to be in the drill holes, they wouldn't be drilling them. You've got to be realistic and expect that some of these things aren't going to work out. And when you've got an early bull phase like this, where the market is kind enough, if you got in early when we were all pounding the table 3 months ago, and you're sitting on a 300 or 400% gain and they haven't even started drilling yet, the market's saying to you, I'm giving you a shot at a 100% risk-free drill spec. Sell 1/4, sell 1/3, you have a zero cost base. If you can set up trades like that, it don't get any better than that.
Exactly.
It's just crazy not to.
Well, and Eric, let's talk a little bit about why people have a problem doing that. And in a bear market, everyone's fearful that they're going to lose more money. In a bull market, everyone's fearful that they're going to lose money because they didn't keep riding the bull. But how many times in your career, Eric, have you been upset about taking profits compared to upset about taking the round trip?
I mean, I'm a guy who swings for the fences at heart. So, I mean, sure, if one of these deals pulls a gigantic hole and their stock goes up 500% the next day, part of me is going to be going, crap, I shouldn't have sold any of it. But the rational part of my mind is still going to know that was the right thing to do. When you're dealing with exploration, you have to play the odds. Like, you have to.
And you want to play like the house too. If you can be the house, which is playing with their money, that's what you're doing when you bring your cost basis down to zero. You're not risking anything anymore. The stock could go to zero and you're okay. It could go through the moon. You're still invested in the company. But yeah.
I just know guys that I've known for a very long time that are very good traders, that are kind of mentors of mine. You think of a guy like Bob Bishop. I mean, Bob used to say that all the time. I mean, when the market gives you a chance to play with house money, you play with house money. Like, it's just stupid not to. You have to play the odds. And,
I think
these are guys that have done extraordinarily well over the years, and I'm quite happy to. I wasn't smart enough to take that advice a couple of cycles in the past, and I'm going to try very hard not to make that mistake this time.
Well, I think we're on the same page there, Eric, and I think it's really good that we're pretty good filters and able to pick good stocks. And I think that, also giving people good strategic advice on how to play the market is probably just as important as being good stock pickers. And I think that is the ultimate goal, is to get your costs down to zero on these stocks and take the risk out. This is a risky enough business. If Mr. Market gives you the chance to take risk out, do it.
The other reason too is when you're early in a market like this, and there's all kinds of good companies, and it's thankfully mainly good companies, not the mutts, raising money right now. The truth is, you're going to find over the next 2 or 3 months, there'll be another 5 or 10 or 20 companies will be sending out news releases going, well, okay, after slogging for 6 months, we finally raised the money and we're going to drill X, we're going to drill Y. And if you're not doing some profit taking along the way, no one's got unlimited resources. you get to the point where you see something you really like, and you're going to have to sell something to buy it anyway. So, you know, why not position yourself so that if something comes up, you can jump on it, and that means making sure you've always got a bit of liquidity.
Right, because that's another thing I think a lot of investors do out there, Eric, is that they don't realize there's always another bus coming along. And if you make, say you make 4 or 5 times your money and the stock goes from, let's say, 50 cents to $2. Well, to go from $2 to $4, it's a double from there. It's not that easy, actually. And you've already made 500% on your money. Why not be looking for something else? First of all, get your risk down to 0, take some profits, and then you can redeploy that money into something that's going to double for you again. You're probably better off to be looking for something new than to try and get those results from that stock that's already performed exceptionally well.
Yeah, I mean, occasionally you're going to see. I mean, and this is what we all hope for. I mean, occasionally you're going to see a play where results are coming back, and you can tell, you know, 5 or 10 holes into it, the company is dealing with something extraordinary, and that's a situation where I got no problem buying back higher and buying more back higher. I'm totally fine with that.
Because there again, it's risk related, right, Eric?
Yeah. I mean, if you think like holy crap, these guys look like they've got something that could be 2 or 3 or 5 million ounces. It's the real deal. And you know, if I bought it at 20 and sold some at 50, it's $1. If I think it's that great, and it could go to $5 or $10, like whatever, I'll buy more of it. That's,
right.
You know, but I'm already positioned to do that. And on that note, I mean, you know, whenever you're looking at these stocks, and everybody listening should think about this. I mean, Alan's comment about there being a new bus in the station all the time is a very important one to keep in mind. If you don't feel, and this goes for anything he talks about or I talk about or anything you read in the newsletter, I mean, if you don't feel any conviction when you read a stock that I start talking about or something I'm updating, don't buy it. Like, don't buy it because I'm talking about it or Alan's talking about it or anybody else is talking about it. But if don't wait for the market to tell you what to do. I mean, do a bit of due diligence and decide whether you like it at the price it's trading at. One thing I see people do all the time, and it's generally people that are new to the sector, they don't realize that as exploration progresses, the market will continually revalue the company, and the market has a habit of overshooting in both directions when it does this. And I'll get email all the time from readers that say, you know, I really like that. You know, I'm just picking an example here, folks, just so we got a name attached to it. I really like that Colorado when you're talking about it at 10 cents. But I don't know. I was waiting, and then Adam put out these great drill results, and it went from 50 cents to $2, and I decided, well, okay, the market likes it, so now I'm buying it. And I'm sitting there going, like, wait, what? Like,
what do you run a major?
It's usually an email from someone going, like, how come it isn't still $2? And it's just like, okay, what? Like, I pounded the table at 10 cents. You waited till it was $2. Like, people do that all the time. They wait for the market to tell them to buy something. But it's okay if that's where your head's at, I guess. But you got to recognize that your risk is going up and up and up when you do that.
Exactly.
And if you didn't feel any conviction at 10 cents or 50 cents, just wait for the next one.
Yeah, there's always more.
Another one.
There's always more coming along. I have never in my career had a problem finding a new story to look at. Now, I might not look at as many as I used to or cover as many as I used to. And that's because I believe that this, we're starting a new bull market. So it's going to be more confined to those with really high quality. And I hope that that's the way it continues into the future. But, that's what I'm looking for right now is quality at cheap prices. And I don't have any problem finding a new story.
There's lots of them around, and I mean it always gets tricky when one of these markets is starting up because you're feeling pretty smart because you bought a bunch of stuff for 3 cents and 5 cents and 10 cents, and then 6 months later, a similar stock is 20 cents or 30 cents. You're kind of going, oh man, that feels expensive. But if it's a real bull market that's going to go for 2 or 3 or 4 years, and I think that's what we've got. I mean, all of the prices will keep shifting higher. So,
well, I'm going to say
you're not going to keep finding perfect companies at 3 cents like you could find 4 months ago, where nobody wanted to ever hear about these things again. I mean, they all get a bit more expensive, but it's relative value you're looking for.
Exactly, and it might get more expensive, but also a little less risky for you, a little less volatility. And I agree with you, Eric, that we're in the early stages of a multi-year bull market in gold. What gives you that confidence, Eric? I harp on a lot of things. What's giving you that confidence? And that probably comes something we can. Oh, I just lost Eric. I'm going to call him right back. I want to wrap things up with Eric before he has to leave here. He'll be right back on. I'll get Eric back on the phone, and I'm going to wrap it up on that gold question. He'll be just a second here. I'm sure I've got it. I got a call going out to him. So yeah, I want to wrap it up on it.
Hi, Alan.
Hey, Eric. No problem.
I don't know what happened there.
That's no problem. I wanted to wrap it up, Eric, because you got to go pretty soon here. Let's talk a little bit about why you think we're in a multi-year gold bull market.
I mean, essentially, the reason is really the thing I keep coming back to, which is the negative interest rates. If you look at very long term, and by very long term, I mean 50, 100-year trends and 50, 100-year cycles and charts, one common theme that you generally see with rising commodity prices in general, although with the generally weak economy right now, I'm not comfortable spreading out too much from precious metals, but generally in the past, these long cycles tended to be associated with negative interest rates. Normally, that was because you were actually in an officially inflationary cycle, and the world's central banks and bankers were behind the curve. They weren't raising rates as fast as inflation was going up. In the current case, it's a little different because you've got central banks intentionally pushing interest rates down to try to generate liquidity and keep the economies growing, but the end result's the same, which is negative real interest rates. And those trends are things that they tend not to change that fast. It's not a situation that central banks can back out of very easily. The other thing is, talking to brokers that I know that have very large books, that have institutional clientele, one common theme I've heard in the last month or two is they are seeing more and more outside money coming in. And by outside money, I mean big institutions, funds, endowments, that kind of organization that has mountains of money. They're not gold bugs. They're not speculators per se. They're simply looking at that same trend and saying, this is probably something where I should be positioning a little bit of money. And that money is really just coming in now. And these are very, very large scale players that move hundreds of millions of dollars at a time, and they're kind of like a super tanker. It takes them 3 or 4 years to decide they should be in a sector, but by the same token, these aren't day traders that the gold price drops $20 and they're all going to disappear. I mean, when this kind of money moves into a sector, it tends to stay there for 3 to 5 years. So I think that's going to be a good underpinning for a while.
Well, I certainly hope you're right, Eric. That big money coming in kind of falls into the argument that I'm making to be bullish on gold stocks, is that they only have a small menu out there to choose from of quality, and as a big crowd of money comes in, they're only going to have so many companies to look at, and that's why I'm trying to focus on less companies this bull market, but cover them more closely for my audience.
Well, I think the mergers that we're seeing lately, that's obviously helping too. I mean, you see something like, Sun Reservoir. I follow both of those. You look at Kamenar being taken over, which I follow. Gold Rock being taken over, which I follow. Those transactions are still going through. The actual takeovers won't be done for a month or so. That frees up a lot of money. I mean, I think there's a lot of people that own those various stocks, and that money, somebody gets a big win in a sector, more often than not, they're going to recycle that money back into the sector they just got a big win in. So I think that's going to help too. And that's not so much just big institutional money, but a lot of retail guys just got a big win on all those things, and they're looking for the next one, and they're looking in the same place.
Well, we'll keep on trying to find them for him, Eric.
Yep.
Thanks a lot for joining. Thanks a lot for joining us again, Eric. It's always an enjoyable conversation with lots of knowledge for my audience.
Always great to talk to you, Alan. Thank you.
Thanks a lot, man. We'll do it again soon. I'll let you go here before you miss your next appointment, and I'll wrap things up. On that note, Again, I want to stress that this show and my reports are for information purposes only. It's important for you to do your homework and speak with your financial advisors before making any investment decisions. I want to thank my sponsor or my guests, my audience for tuning in, and for my sponsors making these shows possible. It's a great opportunity I have to have an audience like you and have great guests and great sponsors. So I know I'm a very fortunate guy, and I'm happy I'm able to put these reports together. On that note, you have a great day, and we will talk to you soon.